This week we're gonna have a look at ASML. This is the maybe not as well known as they should be Dutch company that makes the world go round. Because what ASML does is they create the machines that create the microchips that we all use in our smartphones, in our computers, in our microwaves, fridges, whatever you have a microchip in, the drones that are flying everywhere. All those machinery need microchips, they need computations, and all those chips are mostly being made by the machines made by ASML. So when you think of like the big semiconductor companies like Intel or TSMC or AMD or Nvidia, all those companies, they design the chips, and these chips then get made at a foundry of like TSMC or Intel, or Samsung has a foundry as well. And this is where the chips are being made, and they're being made with the machines which are bought from ASML. So ASML is a very, very important company and very much a key player in the current microchip semiconductor war that is going on between the United States and China. But we'll get into that in a little bit. First, let's have a look at their financials. So what we see here is in 2012 they spun off from Philips um, several years earlier and created their own company, ASML. So they used to be a part of Philips previously. In 2012, they had a revenue of 4.7 billion, which is already quite impressive, with an earnings of 1.5 billion, which are already some amazing margins, right? But they make high level machinery. We expect them to have some certain margins because apart from R&D and development, they don't have to, I don't know, lease a lot of places where they can host their storage, lease a lot of trucks, or a lot of employees. Although to be fair, I think ASML actually has a fair number of employees, but mostly because they need to do research and development. So the revenue here started as 4.7 billion, has raised all the way to 18.5 billion, which is an annual compounding growth rate of 16.4%. Very, very nice, very impressive. Um, and they definitely, during those 10 years, created a foothold for themselves where no other company is even close to reaching their technology. So if you're looking at mode, if you're looking for a company that you know is going to be around in the future, I mean, no one can predict the future, of course, but I think it's safe to say that ASML is going to be around for at least a few more years, where they are almost a monopoly entity when it comes to the machines that they're building. Because right now they're working on EUV machines, which is the absolute cutting edge technology that is being used now to, well, not even being used, they're still being developed, but they plan to be shipped out later this year to Intel and TSMC to make the new generation of chips. So the revenue has grown to 18.6 billion. Their earnings have grown to from 1.5 all the way to 7.8, which is an annual growth rate of almost 20%. Almost 20% growth year over year. Absolutely ridiculous, actually ridiculous. And what we see here as well, the difference between these two is that their earnings are growing faster than their revenue, which means they are becoming more established, they are becoming more effective in managing and operating their business, and they can cut some expenses. So very impressive growth, very much what we like to see, and very much also I think a little bit what we expect in the semiconductor industry. Looking at that debt level, frankly, there's not much to talk about. That debt level has been insanely low and can easily be paid off by even half a year's of earnings. So kudos for them for making sure that that debt level is as low as can be. Especially if we look at the excess cash that they have on hand. Every single year they have a lot more excess cash on hand than they have debt on the balance sheet. So whenever they want, they can easily pay off the debt if they want to. So again, that's very much a big plus. It's not a company that's in any risk of going bankrupt. I think it's showing as well that this company is run by some very, very smart people. I think one of the smartest people in the world, ASML. They hire some of the smartest people, and it very much shows in the effectiveness and way in which they run their business, as well as the management, because management is still very highly held in very high regard, even by their employees, which I think speaks is a testament to just how well management has been doing. Looking at the market cap, it has, well, more than 10x over the last 10 years, which made it a great investment for anyone getting into 2012. Annual growth rate of 32.5%. Anyone can only dream of returns that high. Enterprise value, which is basically the market cap to which you add the debt and extract the cash, subtract the cash. But since the cash and the debt is basically at the same level, we're mostly looking here at market cap, and that's why we see that enterprise value has pretty much grown in line with the market cap. Looking at the EV/EBITDA ratio, this is how many years on average it would take for their earnings to buy back the entirety of their company. This is the premium that a company is selling at. What we usually see with growth companies, they have a much higher multiple because the multiple is going to come down relative to the year that you're looking at in the future anyway. So that's why they often trade at a high multiple, because the growth is pretty much priced in already. And this is also what we see with ASML. They started up with 14.4, but then later on they really proved themselves to be a sustaining and continuously growing company. And they grew all the way to about 40 times earnings, which is quite a high number there. And it will probably come down from this number. It already has come down from this number, but still very, very impressive. Net to EBITDA ratio is really not interesting because their debt level has been very, very low. Okay, looking at their cash flow. Now, the cash flow from operations, this is all the money that they make simply from producing their machines and selling them out to whoever is buying. Now, I mentioned at the start of the video that ASML is going to be finding themselves in the middle of a chip war between the United States and China. And the United States actually told ASML that they will not really allow them to sell their new high-end EUV machines to China because they fear the technology in the wrong hands could actually lead to some calamitous events in the future. So the US pretty much told ASML to not sell their high-end product to China, which is actually one of their bigger buyers. I think in 2021 alone, about 2.5 billion of their earnings have come from China. So about 1/3 of their earnings has come from China, which is a pretty high number, right? Well, to be fair, most of it is coming from the United States, but China is definitely number 2 there. So that might actually hurt him a little bit here in the short term. As long as this semiconductor war is going on between the two, it might cut into the margins of ASML because they're no longer allowed to sell their cutting edge technology to China. But to be fair, when you look at their order books, they have pretty much been booked all the way for the next few years by selling many EUV machines to Taiwan and to the United States and to Korea for Samsung. So they're pretty much booked for the foreseeable years anyway, but who knows what will happen after that. So cash flow has been steadily increasing from 1 to all the way to 7 billion. About 22% year-over-year increase in cash flow from operations. When we look at their capital expenditure, we can see it hasn't really grown as much as the cash flow has from operations, which is very much here what we like to see. Because again, just like with the revenue and earnings, it means that their margins are increasing. It means they're becoming more efficient in actually running their business. Now, what you have to take into consideration here as well is that they also have to do quite a lot of R&D expenses, which are also very much included in this as well. At least on the annual statement it was, so I'm also including them in this as well. Research and development. I mean, ASML has the leading position because they invest a lot in research and development, and that's why they're in the position that they are right now, and they will very much continue to invest in that to make sure that they have this position and can maintain it for the foreseeable future. Looking at the free cash flow per share, now this is something that every investor should be interested in, okay, because this is your pro rata ownership of the company. This is pretty much after ASML has done all of their expenses and they paid their employees, they paid the materials for their devices, they leased their buildings, they hired new people. This is all the money that is left in the vault at the end of the year that they can play around with. And this is the money that you as an investor have a right to well, not a right, but is used to better you as an investor. And what we see with ASML is that they are paying out a a very steadily increasing dividend, as well as buying back shares, which is exactly what we like to see as an investor. We'd like them to buy back shares so that our ownership percentage of the company is increasing without us really putting in much effort. And this is very much what they're doing. So the free cash flow has grown from 600 million all the way to 10 billion here in 2021, which is massive, massive, massive. The share count here has been decreasing ever since 2014. They've been consistently buying back shares, and they are giving some shares back to their employees as stock-based compensation, but they're buying back a lot more than that, which is very nice to see. So for over the last 10 years-ish, their share count, well, 0% year over year has come down, but it has come down, and that's something that I think we should keep in mind, especially with their increasing earnings and increasing cash flow. They're probably able to buy this back even more. Looking at free cash flow per share, we can see that 2021 was a ridiculously high year. Cash flow per share was, I don't know, I have no words for it. It is actually insane. Overall year-over-year growth of free cash flow per share of 36%. That's an absolute growth company for you. Price per share, you can see it here, not much to say. Free cash flow yield has always been relatively low because it's just a high growth company. We expect a very low yield, which is pretty much what we see on average, 2.9%. Now in 2021 it increased to 3.4, and I think it will probably increase from there a little bit more even, but we'll see how that goes in the future. So this leaves us with trying to predict where ASML is going in the future. Now, because it is a growth company, I'm going to be very, very, very conservative when I make an estimate, because they have been doing some insane numbers, and just in case the chip war hurts them more than I think they do, than I think it will, I want to be extra conservative when I give them a forecast. Okay, so that's also very much what I'll be doing. So in the enterprise value model, we can see here that their earnings has grown all the way to 7.8 billion euros in 2021. It's been growing on average about 20%. I want to be conservative. I'm going to say for the next 5 years it's going to be 15%. Even though they're just launching their EV machines, which is their new cutting edge technology, which will be an absolute cash cow for the foreseeable few years anyway, I'm still going to say that their earnings growth is going to come down to 15% because I want to be conservative. So for the next 5 years I'm estimating 15% growth, and after that I'm estimating 12% because again, I want to be conservative. I don't know what's going to happen. It's a growth company, and if any competitor takes the edge that ASML has and uses it against them, their margins will shrink significantly, because you have to realize ASML is pretty much a monopoly right now, and the moment they get challenged, you're going to see that reflected in the stock price. Okay, so we have to take that into consideration. So I'm going to give them 12% afterwards. I'm also going to give them a multiple of 20 times. Now, they started off as 14 times, which was very undervalued. There were several other times where they actually were going in the sub 20 range here, which I think were very good times to buy this company. What we saw in the last 3 years, that they've been well over 20 times. And I think especially with the growth that I've been seeing in the past year, and I think that they will see in this year, I do very much expect their multiple to stay high. Probably come down a little bit, but I'm going to say 30 is probably more accurate. But I want to be conservative anyway, right? I always want to be conservative. So I'm going to say 20 times. That gives me an enterprise value 10 years from now of 556 billion euros. Less the debt, add the cash. They basically do nothing to the market cap, to be fair. This means market cap of 558 billion divided by the amount of shares. Now I'm assuming this will come down, but we include free cash flow into our IRR later on anyway, so we don't need to be bothering with that. Gives me a stock price 10 years from now of 1362 euros. And again, this is very conservative considering the history, right? Okay, I want to make that painstakingly clear that this is very, very conservative. If you think these numbers change in any way, if you think, I don't know, they're going to be continuing their 20% growth for at least the next 5 years, I'll just show you what happens with the share price right there. It's going to be increasing drastically. Is the multiple going to be at 30? It's going to be increasing even more, okay? But I'm going to be conservative, so I'm just going to keep it at this number. Looking at the free cash flow model. Now, on average, their free cash flow has been increasing a lot. So I'm going to give them the benefit of the doubt and say that they will take this number of 2021, which very much also included a lot of financial benefits and positive valuations when it comes to the euros. So this is actually a very much the odd one out when you look at the rest of this number. Okay, they saw some additional stuff there, which is taken into consideration for the free cash flow model. But I'm going to be nice to them here and say, okay, we can take this as a starting point, and from this starting point, we're going to moving up. Now, on average, they've done 36% year over year. Again, absolutely astounding. But I'm going to be conservative. I already gave them the benefit of the doubt by giving them this as a starting point. But now I'm going to say that the growth you're going to be having is 15%, just like with the earnings growth, 15% for the next 5 years, and then 12% for the 5 years after that. Give them a free cash flow yield of 4%. Now, historically, they've been doing a lot lower than that. Okay, so just to give you an estimation of what that looks like, if you put it to 3%, it's going to be increasing quite a lot. But I'm going to be conservative here because I've already given them leniency with giving them a starting point of 10 billion here. I'm going to give them 4%, even though I think they should be lower than this. Okay, let me just put that up front. I think they should be lower. So currently, I can buy as many shares as I want for 612 euros a pop. Given our two models, the enterprise value model as well as the free cash flow model, it gives me an average share price 10 years from now of 1,780 euros. If we just look at share price appreciation and we don't look at any of the free cash flow that will be coming our way in the next 10 years, on average, this stock will return 11.3% year over year as pure stock price appreciation. Okay, and this is with conservative estimates. Conservative estimates. So I think already based on that, it's going to be a very interesting company. Okay, but now we continue on looking, and we look at the IRR, which very much includes all the cash flow as shown below here. The free cash flow that will be coming our way, as well as investors holding the stock in the form of dividends, in the form of share buybacks. If we hold the stock, this is what we'll be benefited with as well. And if we include that free cash flow into our overall return rate, I get a return rate of 18.8%. Now, on average, the stock market returns about 10% year over year. And when I look at these numbers, which I think are fairly conservative considering their historic numbers, I think ASML right now, because they've been coming down quite a lot from their COVID highs, okay? I think the share price was about 900 euros back only a few months ago, really. So if you just put that number back in just to see how much exactly the IRR has changed since then. Back then it would not have been a very interesting stock. It would have been a in line with market expectation stock. But right now, because the price has come down so much, it was even as low as 400 at one point. Like the people who bought it at that number, like honest to God, kudos to you, because you made one hell of an investment right there. But even at 612, I think it's a very interesting stock to be holding. So yeah, that gives us an 18.8% IRR. Now, which I think is quite interesting, because ASML is one of the bigger companies in Europe. It's one of the bigger companies in the world, really. And only just a few weeks ago, we looked at Louis Vuitton, which is also an absolute behemoth, one of the actually the biggest company in the European markets. And what we saw when we looked at their financials is that even though they are very interesting and very steady, they do not offer a good return. And that's, I think, if you buy an ETF which is very much weighted, a lot of the portfolio in that ETF will hold Louis Vuitton because it is the biggest company of Europe. And that's why I think on average as well the ETFs will return about 10%, because it also has underperformance like I expect Louis Vuitton to have in the next 10 years. But if you're able to buy a few good stocks, just a handful, maybe just 10 or 15, that have very good financials, and even with conservative estimates will beat the stock market, I I think you will get a lot better return than the average stock market will have of 10%. And I think ASML is definitely one company that you want to have a look at. I'm not saying you want to invest in it, because that's very much up to you. That's your decision to make. But looking at their financials, I think they are an attractive stock to have, and definitely a stock you'll be hearing a lot about, I think, in the future, as the microchips are more and more important in our daily lives. So yeah, I just want to get this video out there quickly, so I'm uploading it today already on the 24th of January, because I think it's important to let people know as soon as possible before the share price goes up. So that was the video for today. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!